Thank you for joining us, James. Here we are in January. A good chance then to look back at the previous 12 months. If we may, let's start with the major market movements you saw in 2014.
Well, I suppose the big story last year really was the move in the oil price.
Yeah.
In the second half of the year, particularly, oil had its biggest annual decline since 2008, and in fact, in the early stages of this year, it popped below $50 a barrel, having peaked recently, I suppose, in 2008 at $140 a barrel, and in the post-financial crisis, it regularly hit $110 a barrel. So big move down in oil, had repercussions for the equity market, repercussions in the debt market as well. But despite that, we saw a reasonable return for the equity markets over the year, about 5% out of global equities, despite being weighed on by the energy sector, particularly in the second half, and reasonably low but positive returns in US dollar terms, at least, from government bonds. So the markets took a bit of a circuitous route last year. It was an exciting year, there's no doubt about it, but the outcome was not bad actually in terms of getting single-digit returns out of the equity market, positive returns out of bonds as well in US dollars.
Yeah, that as you say, that oil impact, that's really weighed on the big producers. A lot of that falls on the US market. Nonetheless, the S&P 500, decent year, no?
Yeah, the S&P was up in double digits in US dollar terms, which was pretty much the best return from any major market over the period. Japan performed similarly in yen terms, but the yen depreciated quite significantly over the period against US dollars. So once that's translated into dollars, yen was in negative. The Tokyo Stock Exchange was actually in negative territory. Likewise, European and UK equities, single-digit returns. Translation effect from the currency actually again in negative territory in US dollar terms.
Global developed markets, you spoke about their positive return for investors. How about emerging markets?
Yeah, emerging markets weren't able to keep up, unfortunately. They underperformed this year. They produced negative returns. Second year in a row, in fact, you've had negative returns out of emerging markets, and that's the first time they've done that for 12 years. So, potentially an opportunity. Valuations are pretty good. They were weighed on a number of factors. High dollar is a bit of an issue for emerging markets. A number of them are oil exporters as well. Again, a large proportion of resources stocks in those markets. So a number of factors weighing on emerging market equity over that period. Debt markets did okay though. I mean, hard currency emerging market debt returned 6%, which was in line with the US Treasury. But despite that anti-emerging market sentiment, they did okay.
Absolutely. Oil's no doubt going to be a big theme. Just before we move on, perhaps a comment on property securities. That's an asset class I know you like to use in the portfolio sometimes.
Yeah, we use it from time to time. We should have had more of it this year. I mean, the property securities market were up, I think 13% globally. The US was up nearly 30%. Which is an incredible return from that market over the year. Clearly we didn't have enough of that in portfolios. That was a particular sort of bright spot, I suppose, from a sectoral point of view. You mentioned oil. I think it's also worth bearing in mind that oil wasn't the only commodities market to go down over the month. Actually, you had agricultural futures lose value over the year, not the month. Gold was down a couple of percent over the year as well. So there's a number of factors sort of reflecting perhaps a slightly lower demand dynamic than you might have expected in the commodities market. Property, despite that doing well, particularly in the US, focusing perhaps on the positive green shoots in the US economy.
Absolutely. Going back to oil then, James, what are we seeing? As you say, these big falls in the oil price. What seems to be driving that?
Well, we talked about it at some length last month, so I don't want to go into it too much again. Clearly there's plenty of supply around in the world where you've got shale oil as a sort of a new entrant, if you like, to the oil supply side of the equation. Likewise, demand a little bit on the shaky side. If you look at the likes of China, Japan, Eurozone, growth there is perhaps not at the kind of levels you would have hoped for, and so demand is clearly a little bit weak as well. So both sides of the equation arguably are helping to reduce the price of oil today. One thing that's worth reflecting on though, that a drop in the oil price, particularly one that's this substantial, is unambiguously good news for consumers, unambiguously good news for most businesses who aren't involved in the extraction and the production of oil, and economies that are oil importers are getting essentially a tax cut, a boost to their likely boost their economic activity simply because of the fall in oil over the last 6 months.
Absolutely. It won't go away as a theme. I suspect we'll still be here in 12 months' time and talking about it. Central bank policy, James, these guys have been the elephant in the room. What did you see in 2014?
Well, I suppose the big change last year was tapering by the US, and then the end of QE in October. People were particularly worried about that. We saw the taper tantrum in 2013. The reality of it was far less exciting perhaps than the anticipation of it. And I think partly that you've got to take your hat off to the Fed to manage that transition in people's minds so well, such that it didn't really cause a ruckus in the markets. But with the exception of that, all central banks, major central banks in the world, are still leaning towards being pretty loose in terms of their monetary policy, still very open. You've got Bank of Japan engaged in very aggressive QE. In GDP adjusted terms, it's greater than anything the US has done yet. And in fact, the Bank of Japan's balance sheet equates to 60% of Japanese GDP now. So there's extraordinarily loose monetary policy there. Europe is already engaged in loose monetary policy. It looks like European Central Bank is about to engage upon taking it to the next step, buying government bonds outright in the market, much the same way as the US did in QE up until last year. That's a big step in terms of Europe, and arguably the bond prices factoring that in already. Is that necessary? Probably. Looking at the data we've seen today, preliminary inflation data out of Eurozone today for December suggests a 0.2% fall in deflation, which is something that Mario Draghi, President of the ECB, desperately wants to avoid, because these deflationary spirals become self-fulfilling. And so again, you've seen, sorry, I was diverged a little bit, but you saw last year concerted loose monetary policy.
Yes.
Looking forward to this year, further loosening in Japan, further loosening in Europe. Maybe the US starts to tighten. This could be the first year we've seen post-financial crisis where the big central banks globally are starting to follow divergent paths. The markets are reasonably hawkish in my view in terms of what they expect the US to do in terms of interest rates. I think the oil price drop, for example, gives the US even more breathing space with respect to their interest rate policy. I don't think they need to put it up anytime soon, even though activity looks reasonable in the US. There's no risk of headline inflation as a consequence of what oil's done in the sort of coming year. And that does build in a bit of breathing space, which is good for the US, but an issue for Europe in terms of the potential for deflation that brings there.
And that print we've seen today, as you say. Monetary policy then, I think it's fair to say, still broadly, supportive of markets. What then are the key risks you see as you look forward into 2015?
I think an important one in the US particularly is earnings growth. Valuations in the US are only really justified if you get a decent level of earnings growth, and there's a bit of a question mark over whether that's a reasonable expectation in a world where global GDP is going to be low single digits. Can you expect double-digit returns in terms of earnings growth? I think that's a bit of an intellectual leap, unless you've got a complete set of high-quality management in the entire US index, or you've got very judicious use of gearing across the board. There's a chance that you'll be disappointed on earnings growth. That is a risk. Strong dollar's a risk. Or the flip side of that, sort of outright currency wars. We see Europe's pretty keen to keep the euro low for obvious reasons. Japan is very much an export-led country. You may well see currency wars between those sorts of economies. Emerging markets clearly have already suffered significant currency drops, and a strong dollar is not particularly good for most emerging markets, so that's a risk to the emerging market side of the equation. There's political risks. Let's take first of all Eurozone. There seems to be a degree of austerity fatigue in Europe. We've seen Syriza looking like it's going to win a snap election in Greece, scheduled for the 25th of January, and that genuinely brings back onto the table the risk of Greek exit or Grexit from the Eurozone, something that occupied our minds a lot in 2012, if you recall. Something that's since then fallen away from most people's sort of base case investment scenario, but now it's very much back on the table. Over the weekend, Angela Merkel, German Chancellor, has been leaked as saying in the press that any sort of Greek exit would now be very much a contained event. It wouldn't have any risk of contagion across the Eurozone. We don't know how much of that's politicking and how much of that's genuine sort of reflection of her view. But nevertheless, Euroscepticism is on the rise outside of Greece as well. UK Independence Party, Five Star in Italy, the National Front in France were all heavily Eurosceptic parties. They did very well in last year's European elections, garnering between them at least 20% of the vote, finishing first or second in the polls as well. So it's clear that there is a number of challenges faced by Europe from a sort of political point of view, aside from the pure economics. In the short term, the ECB has done a great job of papering over the cracks in the Eurozone project, but it does fundamentally need a plan B. Some sort of federalisation, a common tax and spend policy or common banking policy, something that pulls what are very disparate economies more into line with each other over the medium to long term, if the Euro project is really to succeed going forward.
Absolutely. A little bit more on growth maybe. Possibly the US economy has found this firmer footing that some Fed members are talking about. You may choose to disagree there. How about China? Say another big question for investors.
Yeah, well, let's start with the US, and we'll touch on that briefly. The US does seem to be on a cyclical upswing.
Yep.
In terms of its economy. We've got better unemployment. Unemployment is drifting down on a sort of monthly basis. It's not spectacular, but it's going down. Housing market's okay. That's good for consumer. Corporate sector's in good shape. Good balance sheets on the whole. Couple that with a fall in the oil price, a sort of an implied tax cut across the economy. You can make a pretty good case for the US economy today. That doesn't necessarily translate into an investment case, of course, based on the valuation argument we had a minute ago. Turning to China, China's in a bit more of a difficult position. They're trying to rebalance their economy, as we know, away from a very much a sort of investment-led economy to a consumption-driven economy. As of today, 35% of China's GDP is consumption, whereas somewhere like the US, it's 70%. So there's a big swing required there if China is to emulate the US's or sort of the West's consumption-driven economy. The US being sort of the most sort of stark example of that, perhaps. Whereas China's economy, 45% of China's economy today is investment, and so that transfer from investment to consumption is very difficult. It's going to take a long time. We've seen China almost looking like it's in the doldrums over the last couple of months, as the consumption side has not really taken up the slack, not got a head of steam up, whilst at the same time the investment has been withdrawn slightly. I mean, I suppose the other thing China's got to worry about, it's clearly got a debt bubble or a big growth in outstanding debt. How they rein that in over time is going to be difficult. We've seen selective default recently again, and so at least China is prepared to let debt sort of wash out the system now, bad debt wash out the system, which is positive. One final thing in terms of China, at least they've got money to throw at the problem still. There's no shortage of cash in the government coffers. And so as an example, yesterday we saw that 300 infrastructure projects that were sort of out in the future have been brought forward into this year. They look like being $1.2 trillion, $1.1 trillion, sorry, worth of spending. And their ability to bring that forward at least allows the economy to keep ticking over while they allow this transition to a consumption-led economy to take place.
Taking all this together then, James, investors looking forward to 2015, thinking about what asset classes potentially to own. What are your views currently as it stands?
Well, we still think equities have got a decent prospect of delivering returns to investors. Clearly they don't come without risks, and I think buying equities blindly today is a dangerous thing to do. We mustn't be too relaxed about it. We do expect to see periodic spurts up in volatility. We saw it last year in October, November, roughly that time last year, where we saw volatility spike. We saw equity markets dip aggressively and then bounce back pretty quickly again. So people are talking about sort of an increase in volatility, or is it just a return of volatility? Remember, the last couple of years have been particularly low in terms of volatility. We don't expect that to continue to be the case. So we think that risk controls when building portfolios are absolutely key and should be an integral part of your portfolio construction methodology. Where your risk controls come in is difficult today, though. We know that interest rates are incredibly low. The German Bund, the 5-year Bund, is negative for the first time ever. The entire European curve is pretty low. The US 10-year started last year at 3%, finished the year at 2%, and was pretty much a one-way bet for the whole year. Yields at 2% in the US, for example, on the 10-year, it's difficult to see much of an upside there. you sort of got a limited upside, definitely. You've got arguably a greater downside.
Yeah.
You've got an asymmetric return profile from fixed income today. So while it remained the ultimate safe haven in periods of market stress, the absolute headline returns you can get there are only modest. And so the ability to mitigate losses experienced on the equity market, the ability to diversify your risks is arguably diminished somewhat. And in a world that's dominated by QE, we saw it last year, equities and bonds often move together, and again the ability to be a diversifying asset if you move in the same way as the equity market is diminished as well. So there is a place for government bonds in portfolios. It's a risk reduction tool, but I wouldn't expect much more from fixed income than that. You could easily see government bonds return the coupon next year. We're not forecasting a big drift off in yields, but we wouldn't expect to see much more than that. There are opportunities in the credit market. Investment grade is a reasonable proxy over government bonds. If you're prepared to take on a bit more risk, you get a bit more return for it. High yield is still reasonably attractive. In fact, if you're willing to take on a bit of the energy sector in the US, you've actually got a decent valuation now in the high yield market. But you need to be careful as you go down the credit spectrum. A lot of these trades are, if not crowded, they're popular, and you need to be careful in terms of liquidity when putting into your portfolio. Likewise, loans. Convertible debt, there's a place for that. You get a long-term equity option, which in a world where volatility is still pretty low, it implies that option is cheap, and so you're getting, I think, an attractive way of making a play on the equity market without having to buy outright equity, and with a bond floor in that asset as well. EMD still appears reasonably cheap to us, but of course you are taking on that additional emerging market sentiment risk, even if you're buying hard currency, where it's in theory just related to the credit risk and the movement of the treasury curve. You've also got a sort of secondary EM sentiment risk ultimately you're taking on as well, which occasionally manifests itself from time to time. So just be careful on doubling up on risk if you're buying emerging market equity and emerging market debt, and you're taking some kind of play on the oil price as well. They're often quite interrelated trades in the portfolio. I suppose one thing we haven't talked about is geopolitical risk as well, and that speaks to EM, but also speaks more broadly, I suppose. We saw last year Russia and Ukrainian crisis. Russia is probably the biggest risk to geopolitics still today, just simply given the size of its military and the size of the economy and its ability to sort of throw its weight around, which is diminished, but still very much the case. Having said that, Russia is clearly in a lot of pain from sanctions and the drop in energy prices. So any excursion abroad is becoming more and more expensive and difficult to justify from Russia, although it is arguably a populist thing to do. So you'd expect to see Russia winding their neck in unless they're sort of desperate to get some political clout or populist clout at home by doing something abroad. We saw North Korea hit the headlines recently, another sort of semi-nuclear power who are not unwilling to disrupt things. But again, we don't see any obvious big risk emanating out of North Korea today. ISIS, ISIL, a movement we didn't really know about a year ago, came to prominence last year, made rapid movement through Syria and the north of Iraq. They've sort of slowed now. They need a lot of oil revenues as well, so their ability to finance themselves is diminished in a world where oil is $50 a barrel as opposed to 110, say. But there's still a risk. I think the important thing with all of these geopolitical risks, they are focused on relatively small economies. So there's the humanitarian side, which is terrible. We wouldn't want to diminish that, but from an economic point of view, the economies are small, the markets are small, the impact globally is relatively contained, as long as it doesn't spread further from what we see today. The same can also be said for Ebola, I think, and that's important as well. The economies involved are very small today, and so the systemic risk posed by Ebola, which is a relatively frail disease as well, is actually, I think, contained today. So they hit the headlines, they occupy people's minds, but we don't see a significant risk from geopolitics unless you see some kind of massive escalation, and likewise Ebola, I think, is curtailed today.
James, thank you very much.
Thanks, Richard.